Hi, this is Stacey Hyde, and I'm back for another episode of Better Financial Health in 15 minutes or less. And what I want to talk about today are home equity lines of credit, or HELOCs as they're sometimes called. And what that is it's a loan against the equity in your house that you can use to do home improvements, purchase a car, really anything, consolidate debt. And they can be a very useful tool, or they can be a very dangerous one. And the key things to keep in mind is the interest rate on a home equity line tends to be a variable rate that floats with the prime rate. So if the interest rates have risen this year, so have the rates on a home equity line of credit. And in most cases, for the first 10 years, they're interest only, and you can pay back whatever you want on whatever schedule you want. You just have to pay your interest every month. And then in most cases, at the end of 10 years, they will lock the loan and give you payments to pay it back over the next 10 years. That's not always the case, but it's certainly more common than not. And what do you need to think about if you're considering a home equity line? Well, first thing you need to consider is, do you have equity in your house? So if you got a maximum mortgage, 97%, you may have some room in there with the way that prices have appreciated, but you may not, so it may not be available for you. The other thing to know is you cannot, in most cases, get a home equity line on a house that is for sale. So if you're thinking about getting a home equity line to maybe help you bridge the gap, if you're going to try to put a contract on another house and potentially close on that one before you sell your existing house, you need to arrange for the home equity line ahead of time, because most lenders will not allow you to put one on a house for sale. So that's the key thing to keep in mind. The other is, you are putting additional debt on your home, which means that were you to lose your job or something like that happen, it makes it more likely that you could potentially lose your home, because not only do you have your first mortgage, but you also have a home equity line on there, which is going to mean more payments. And as interest rates rise, the interest is going to be higher. Where it can be helpful is that the interest rate on a home equity line is generally considerably lower than credit card debt, so it can help you pay those off and get ahead. But you have to have the discipline, and this goes back to something I talked about in a prior episode about money is not all about math, it's a lot about behavior. And so if you pay off the credit cards but using a home equity line, and then you don't quit the spending that allowed you to accumulate that credit card debt, you're just going to find yourself in a worse off spot than you were before. So you really need to be careful with this type of debt, really with any type of debt. I really encourage people to be very careful about when they add payments to their life, whether it be for a car, a new mattress, whatever it is, because you want to make sure that you're not pinching yourself too tight. And when the cost of things goes up, like gas now, groceries now, pretty much everything right now, that you're not squeezing your monthly cash flow to where you have no choice but to add it to credit cards, because then it gets very, very difficult to catch up without potentially getting a second job or selling some of your things. So a home equity line of credit can be hugely helpful, especially if you want to put some and redo your kitchen or something like that. That's really sort of, in my view, sort of the best case scenario for it. You're using the money to improve your home, and then depending on what interest rates are and how long you're going to stay in the house, some people will wind up refinancing both their primary mortgage and the HELOC into one loan once they're all done. That is not as attractive as it once was when mortgage rates were at 3% and now they're closer to 6%. Especially if you have one of those 3% rates, you're going to want to just keep that one, pay your regular payment, don't pay extra, and really concentrate on making the home equity line go away. Because at the end of the day, the less debt you have, the more options you have and the more freedom you have, which that really is the best way to sleep well at night, is to owe as little as possible. So home equities can be great. Different banks will periodically run promos where they'll offer them with no closing cost. That's something to take a look at, and you definitely want to shop around because some will require an appraisal and that's probably going to run you $500. Some of them are going to have other fees. It just depends on what your loan to value ratio is. So the more equity you have in your home, the less expensive it is to get this type of loan. And so you want to be cognizant of that. Ask around, see if you qualify for any special programs at a local bank or credit union. So be careful out there, pay attention. I know budget is not a popular word, but being mindful of your spending and knowing what your fixed costs are each month, and then also what your variable costs are each month. You don't have to know it to the penny, but knowing in round numbers will really help you and help you make the best choices longer term. Thanks for tuning in. This has been another episode of Better Financial Health in 15 minutes or less.